All right, all right. Well, welcome everybody to the first Wealthologist Live of 2025.
That's crazy.
Pretty exciting. Already been a bit of an exciting year, so we're going to be digging in here shortly. I'm Chris Hobart, the Wealthologist, and I'm excited to, as always, dive into some of this financial stuff and always talk about it with our lead investment strategist, Jacob Woodrum.
Yeah, good to be here.
I know I'm excited because we're going to be talking about some trends, some strategies, and also get some key insights. So that's going to be really exciting as we kind of let people kind of come into the event. We were talking, so Jacob and I would sometimes say, how should we talk? And it's funny because this morning Jacob came in and he actually accidentally busted my chops. And
accidentally.
So what it is, so I'm going to tell you this story. It's about my daughter. So for Christmas, my youngest daughter, 12 years old, she loves to collect water bottles. We've got so many water bottles around the house, Stanleys and Owalas and all that. And I would joke with him, oh, Dad wants a water bottle too. Anyhow, so I get a water bottle. Now, this is my water bottle. I've got 2 daughters and a wife. It's not necessarily a tough guy water bottle. To make it worse, anytime I use it, because I use it to try and make my girls feel good, right? Hey, Dad's using his water bottle. But I also feel like it kind of looks like my daughter's water bottle. Well, Jacob comes in and he sees it on my desk and he's like, oh, Allie's got the same one. Allie's his wife. And then he said, well, I just assumed that you had borrowed Blythe's. Now, Jacob wasn't trying to be mean. If you know anything about Jacob, Jacob's not a person that can be mean, I don't think. But here I was looking at my water bottle. That's a gift from my daughters, thinking, oh, why couldn't they have got me like the army green one? Maybe something a little bit tougher.
And then immediately after I said that, I felt bad because I.
as you should
Anyways.
have, as you should have. So to get back into it, there's our story for this one. But as we mentioned, I'm going to be joined today by two guests. We've got, of course, Jacob, and he's going to share the signature 3-2-1 insights with us, which is that fast-paced look at three impactful economic events, two managed portfolios that we manage in-house here that we really like right now for different reasons in the economy. And then we're going to have one financial tip that you just don't want to miss. And then we are going to bring back our special guest that you know and love, Corey Sundstrom. Corey's our senior wealth advisor as well as our director of financial planning. He's also an expert in tax strategy who's going to be breaking down some of the recent tax law changes that have occurred or are expected to occur with the new administration. Specifically, we're going to be talking about some that are impacting retirement accounts. And Corey's also going to join us for our quick fire Q&A session where we're going to get answers to your most pressing questions that you have sent in. So I guess if you are ready, Jacob, are you ready for the 3-2-1?
I'm ready.
All right, if you're ready for the 3-2-1, we got our fancy graphic here.
Perfect.
So now today you're going to be walking us through I guess what we'd call a year of contrast, right?
Yeah.
And as we talk about that, there's a lot that's gone on. There's been some market moves. There's going to be some different risks on the radar that we're keeping our eyes out for. So I want to start out with the three, the three things that we need to be keeping an eye on in the economy. So if you want to go ahead and dig in, and of course my little button's not working to do that.
Oh,
so there we go. Now it's working.
Yeah. So let's dig in. And I think the first, to your point, Chris, the first thing that I really wanted to kind of focus on is, as you mentioned, kind of a year of contrast. So, kind of balancing this strength versus volatility narrative, which is what we're expecting for this year. And, this year, I think it's going to be kind of I guess I'm calling it more of a year of economic resilience, but I think the key is that expect a little more volatility this year, as far as the markets are concerned. Growth is supposed to be good this year. GDP about 2.5% growth, which is competitive, and the job market is supposed to be steady. Now, I will say we're starting to see a little bit of slowdown in jobs, and that's really important. We've got a slide that we'll look at specifically about that in just a second. But, historical trends for the first year of a presidential cycle are actually pretty positive as well, coming in on average of about 9% average annual return. So it's interesting to see.
Hey, you brought up the employment thing, and I just did in a recent Wealthologist Weekly, I talked about this, which, employment growth over the past 5 years, I think it's been the majority of employment growth has actually occurred either from government or from medical or healthcare, which is highly correlated to government when it comes to job growth. It's going to be interesting because, just in this first couple of days, we are hearing about that shrinking of the U.S. government, which means less job growth in that area. And it's going to be interesting to see, does the private sector kind of sop up that job growth or not? So we'll pay attention and find out.
Well, and I think that points to the expectation of a little more of a cyclical market, which just I know that's a technical term, but just means more volatility. So I think just preparing for more of a bumpy ride. But let's pull up though we've got that jobs slide.
Yeah,
so I think this is pretty interesting, and this is just kind of reiterates the point that I just made about the labor market and jobs being so important. What we're looking at here, and this was some research that Goldman Sachs did, but it's basically letting us look at the estimated impact or effect of a 1% unemployment rate increase. So if we saw, and now again, 1% is a pretty big number. I think right now we're sitting right about 4.2, 4.3%. So if we were to go to 5.2, 5.3%, what type of impact does that have, on the stock market? And we can see, based on current valuation levels, well, we may see a 10% pullback in the market if that were to happen. And so again, I think the theme here is, economic resilience, but a little bit more of a bumpy ride.
Well, it's interesting because I think the general money is looking and saying, look, the market is overvalued. I think the recent number is it's 20% overvalued, and that's a scary thing. You'd say, 20% overvalued, what's that mean? The interesting thing is the Fed's still sitting, I think, on 750 billion.
It's a big number.
In a side account that's basically they're just waiting to release.
Yeah. And you've got all the consumers
yeah.
who are sitting on a lot of savings too.
And that liquidity, I got to tell you, it solves a lot of problems when they have that kind of that dry powder. So.
Right.
But that's great. All right, what's our next point?
Yeah, so
next economic
let's talk next. Shift gears a little bit, and I've got 2 slides that we'll look at. But the theme here is kind of a smaller stocks and some smart moves that I think we can be making. When we talk about smaller companies, that's kind of you think about big companies as in your Apple, your Microsoft, your Nvidia, these mega cap tech companies. But what we've seen over the last year is that they are expensive. So from a valuation perspective, we've seen them go up a lot, which has been great from a returns perspective, but they are expensive. And when you compare them to small mid-cap companies, those companies look a lot more attractive.
Now when you, just to break things down, when we talk mega cap, mid cap, and small cap, mid cap is mid capitalization, right?
Yeah, mid capitalization.
So I mean, not that everyone needs to know what that means, but when you hear those fancy terms, that's kind of what it breaks down. And that just means it's a medium-sized company, and small cap is just going to be a smaller company, not a private mom and pop. Still something that is going to be trackable on an exchange in some way, but a small company. And usually, think of them almost like as I look at them as ships, right? Those small cap companies can tend to pivot real fast, but also when a big wave comes, they
get rocked a little bit more.
Get rocked quite a bit.
Yeah. So the thing that we'll look at here with this slide, just briefly, what we're looking at is the S&P 500 forward price to earnings, and we're looking at this over the last 30 years. And when we think about price to earnings, that's just a metric that measures how expensive or how cheap the market is based on the price of the index, based on the price of companies, and then how much they're distributing in earnings. And we can see, on average, the market, the S&P, the price to earnings, it's been about 18.5. That's been the average. One standard deviation above that, more extreme, is about 22, and then below is about 15. We're currently at about 25. So to your point earlier, Chris, I mean, we are sitting there in a market that's a bit overpriced. But this next slide, I think, gets a little bit more granular and helps us to see, okay, well, what's driving the valuation? And what we're looking at here is, again, the S&P 500 broken down by market cap, range, and weights. And I know we're going a little into the weeds, but just hang with me. What we're seeing here is this first 1 to 10, so the top 10 companies of the S&P, the Mag 7, the Apples, the Microsoft, the Nvidias of the world, their PE is 31 times, but they account for almost 40% of the S&P 500 because of the weighting, in the market. So if you look at this a little bit further, you can see that the bottom, 300 companies in the S&P, their price earnings are only sitting at about 17 or half, approximately, of these big companies. So we just expect, as we move further into the year, I think that's going to kind of shift a little bit, and we see some opportunity in the small and the mid cap space.
Yeah, let's. Oh, actually, we're not ready for number 2 yet, are we?
Not yet.
I'm sorry, I jumped the gun. So. All right, keep it going. What's our last economic update?
Yeah, last economic update. I want to talk a little bit about just navigating between risk and rewards, because we've got inflation, we've got rates, we've got tariff talks. There's a lot of stuff going on, to your point earlier. And housing costs have been one big driver of why inflation has still remained above the Fed's target. But we do expect about 2 Fed rate cuts this year. So I'm thinking 2. Depending on who you talk to, some say more, some say less. You want to put any money on it?
I refuse anymore. I got to tell you what, it is impossible to bet that game.
It is.
Because I miss the good old days, Jacob. This white hair, I remember the days when it seemed like all the rate cuts made sense. Now it's just, who knows? Who knows?
I think we're going to get 2, though. So, we're expecting 2, which does tell me there's some opportunity in, and again, I'm going to use a technical term, in mid-duration bonds, meaning not a 30-year bond, not a 6-month, bond, but kind of a 5 to 6 year range. If we get 2 rate cuts, we could see some opportunity there, and that kind of points to one of the portfolios that we'll talk about here in just a bit. Tariffs, Trump came out a couple days ago and basically pulled back a little bit on the tariff talk. He's not going to put tariffs on everything and everyone, which I think is a good thing overall. But it's just something to be mindful of. And, I think the elephant in the room is just government debt and how it's just been increasing so much. It's a concern. It's something certainly to be mindful of. But, Treasury yields are sitting close to 5% now. And that certainly is a buffer and kind of provides a hedge against some of that risk.
Yeah, I mean, definitely. It's interesting. You mentioned the tariffs as well. And I think during the election, there was talk of tariffs and that, a lot of historical views on that.
Yeah.
What's interesting is what I'm looking at now, because this news just came out, I think it was last night, but how Putin's kind of coming to the table because the use of tariff it's scary for the U.S. It's kind of like not great for, there's some potential drawbacks, but
right.
These other countries, they're scared to death of that stuff, which is an interesting thing to cudgel people with, right? Hey, we're going to tariff you. Nobody wants it. Right. I mean, really, the U.S. doesn't want it. The other countries don't want it.
It's almost more of it's kind of a bargaining tool, I think, than it's anything at this point.
Yeah, let's hope that bargaining tool or that pays off. That's the hope.
Yep.
All right, time for our 2 portfolio picks. Obviously, when I talk with you about choosing portfolios for this segment of this, it's with what we just talked about in mind. Looking at where the economy's at and what people might want to think about for various reasons. So go ahead and dig right in.
Yeah. So let's talk first about our Income Shield portfolio, and this is a 100% fixed income, so bond portfolio. Right now, it's yielding about 5.25%. And I look at this, and we've really utilized this a lot for folks, kind of as a cash alternative. Because if you think about, we're expecting 2 rate cuts. Again, we could see a little more, could see a little less, but we're expecting rates to continue to come down. Well, we know that if that happens, cash is going to, the yield on cash is going to reduce as well. And so looking at a portfolio, a very, I would say, conservative bond portfolio that is yielding more than cash and has the ability to do better than cash moving forward just makes a lot of sense.
It might give us a little bit more integrity at that rate. That rate will stick around maybe a little bit longer than like cash. Cash can change very quickly. And money markets can change quickly. This should give us a little bit more integrity to that rate.
I think
for a while,
so. Yeah, I think so.
Which is good.
So something to think about. The second portfolio that I want to talk about is nothing that I would say this is not a super, I've said it before, not a super exotic, not a super kind of sexy portfolio, but it's just a moderate strategy. And it's a blend of stocks and bonds, about a 75-25 mix. And one of the keys or key points to make with this portfolio, and the thing that I like about it is we've, to the point, looking at kind of the expensive big cap, mega cap tech companies versus the smaller companies, we've made some intentional moves to try to reduce some of the exposure to the expensive stocks and look to gain exposure in some of those areas that we see as a little more favorable. We also have bonds in the portfolio, about 25%, so not a lot, but enough to kind of stabilize and I think provide some ballast, to the portfolio. And again, in an environment where we may see more volatility this year, it's kind of nice to have a ballast to the portfolio. So,
and I mean, those are 2 strong and just what we call like a smart portfolio. Again, to your point, nothing exotic, but look, for those of you that are wanting to get a better return on a cash or cash alternative, we've got something.
Right.
And for just a nice balanced portfolio to kind of scratch that itch, I guess, that's what those are for. Now, of course, we always have more exotic things. But hey, that's not everybody needs exotic. Right. Not everybody wants exotic. Yeah. But some of you do, and we've got that too.
We do.
So now, what is your one financial tip?
Yeah. So the last thing I'll talk about before we bring on Corey is financial tip. And this month I think this kind of speaks to what I've been talking about so far. But just diversification, is really your friend. And I know we talk about diversification a lot and probably over talk about it to some degree, but it is truly important. And I think this year more than ever, having a smart balance and kind of allocation across asset classes really is going to be key to balancing, kind of the growth aspect, but also the stability aspect just because of the volatility piece.
I think the important thing to consider when we're talking about diversification, historically, people have thought, okay, diversification means stocks and bonds,
Right.
And again, that is a form of diversification, but the higher you swim upstream with your net worth, typically what you're going to see is you're going to see that there's greater diversification in what we call non-correlated assets. I was actually just at a meeting this past week, and one of the things that they were talking about are some different investment vehicles that actually are going to have ownership in sports teams, which is, I couldn't think of some of our clients, and that's like, wow, that'd be really exciting.
Right.
Not for everybody, not for most, but it is an interesting way to non-correlate, because there's some recent regulations that allow sports teams to be purchased through private equity.
Yeah.
And now, again, in talking about diversification, it's one heck of a way to diversify your portfolio. And there's different types of growth that happen. The key here is diversification means trying to grow different buckets of money utilizing different sources of growth.
Yeah.
So I think that's a great tip, specifically if we're worried about, or not worried, but questioning about where the opportunity in the market can be. Sometimes spreading the chips around to different areas is exactly where you want it to be.
That's it.
So that is going to be our wrap for the 3-2-1. So Jacob, I appreciate you doing that, and I'm going to go ahead and welcome our next guest, Corey. Boy,
Man.
Guys, that was seamless. We were all worried about in the office, like, how do we do this switch? And I put a slide in there, and nobody out there.
They don't know. They don't know how I entered.
Yeah, they're like, wow, the same height as Jacob, just a little bit different. So, all right. Now that we finished up the 3-2-1, Corey, I asked you to be here today. Obviously as our director of financial planning and also working with our clients, you get to deal a lot with different things and a lot of questions coming up. And I know a lot of questions have been around tax laws, specifically with some changes that have come in with the administration. So I'd love for you to talk a bit more about that, and maybe give everybody some perspective as to what's going on. And then we're going to do the quickfire Q&A as well.
Yeah. So let's actually rewind back to 2017 before we talk about future increases or changes to the tax code. If we remember back in 2017, Trump was in office at that point in time.
Right.
He proposed the Tax Cuts and Jobs Act, which was an effort to change the tax code in a way that for a lot of people reduced their taxes, specifically for the upper end of the tax bracket, but also we found that it had effects across the entire population. So back at that time, what happened is the income tax brackets lowered. They widened a little bit, so it took more income to fill up the lower brackets, which helped people a lot. The standard deduction was doubled, and so that meant that people were getting a lot larger write-off automatically without having to itemize on their taxes.
Less receipts.
Receipts, that's right. And on top of that, the estate tax limitations were also increased significantly.
Right.
They were actually doubled.
Yeah, and that was big, because as people's net worth grow, you kind of allows you to eke more into passing on to the next generation.
That's right. So ultimately what that did is that simplified the tax code for a lot of people. What it did not address was this looming federal debt or national debt that we have.
36 trillion?
36 trillion and climbing.
Yeah, it's a number.
It's a little bit more than we're used to seeing, at least in our everyday life, that's for sure. Anytime we decrease taxes, that's less revenue going into the government. They did not slow their spending through Trump's administration or Biden's administration, really. So that deficit continued to grow. And we had this expectation that the tax code is already set to sunset at the end of this year. And so what that means is taxes were meant to go back to the brackets that were in place before Trump was in office, which meant that the brackets would squeeze down, the standard deduction would then be cut in half, and we'd be back to where we were. Now, in light of what has happened in the election, there is a good chance, based on rhetoric that has been done through Trump's campaign and comments, that they are going to seek to extend the current tax code. So rather than letting it sunset, what they're going to attempt to do is extend it. And some of what Trump has said is, hey, we want to make this permanent. We want to bake these Trump tax or this tax code that I put in place and make it permanent so that it takes in a significant act of Congress to undo it. Now, will that happen? I'm not so sure. I think that's really difficult for Congress to score in future budgets. So we're talking about a pretty big decrease in revenue over a long period of time that in order to make that work, you've really got to see reduced spending in Washington. And, will they be able to accomplish that? There's certainly plans out there, but it's hard to say.
Well, I think that's going to be the interesting thing. Just in general, the whole concept of those tax codes being pushed forward without corrective behavior scares me to death. Look, for our clients, I love the tax code. I mean, for so many people, I love the tax code. We've been able to do a lot of conversions. We're still going to be talking about that. But there's still that big blinking red light out there, which is, hey, at some point, our debt does become too big for us to really handle.
Right.
And then all of a sudden, it's a matter of bigger issues. And we don't want to see that. So I do think that there's got to be that conversation of how do we address the spending, because it's gotten out of hand. And there's some stuff that I hear right now that I'm kind of like, this is intriguing. Love the Doge or the Elon Musk thing or not, it is intriguing to have somebody look at the markets and say, okay, or the government and say, here's what we're going to cut. Now, they did this before. They had this, and there was a big proposal. I think it was in the 80s the last time they did this, and it was great. Everyone said, this is what we're going to do. But unfortunately, because the government is the government, nothing really happened. So I think that these are the things that we got to watch out for.
Yeah, and I think realistically, there's some sort of negotiation that happens within Congress when we're talking about the budget committee and what's going to be reasonable. And so I think my expectation is that the tax code is extended from where it is today. It's likely that will end up being another 4 to 8 year period is my guess. It's hard to say at this point, but the prospect of that being permanent seems like a lot currently. The one thing I did want to just mention, because we're talking about the tax code staying the same, and just getting small inflation bumps to tax brackets and limits and stuff like that. There is one other significant piece that has been proposed, and it was a big item that a lot of people didn't like about the changes, and that was the SALT deduction. So the state and local taxes that were capped at $10,000, if you itemize your taxes, they are talking about uncapping that. Going forward. So there could be people that, even though the standard deduction is great, especially those that live in the Northeast that have a large amount of property and state and local taxes, that could be itemizing again based on their situation.
Yeah, that's a big one. Yeah. Specifically, look, we live in Charlotte. Our property values, well, not the Northeast. I mean, we're starting to see more and more of that even happen here in Charlotte, because everybody from the Northeast is moving down here and driving our prices up.
Yep.
Hey,
exactly.
I own a house, so I'm okay with you driving my prices up. Not my tax rates. Leave my tax rates alone.
Yeah.
All right. Let's jump into the quick fire Q&A, because I know you've got actually right after this you've got a client meeting.
Yep.
So Corey is in the middle of working and having fun with Chris. But I'm going to ask you. Today we're going to cut it down to 3 rapid fire questions. We're going to make it super quick, sentence maybe 2, and kind of make it that way. Are you ready?
I'm ready.
All right, let me get this queued up here. Make sure I've got our first question. All right, Corey Sundstrom. What's the most tax efficient way to contribute to retirement accounts in 2025?
You limited me to 2 sentences here, so that was probably 3. First is make sure you're maximizing Roth contributions wherever you can. That will help you in the future, I promise, for most people. Secondly, remember, new part of the tax code this year, if you're between the age of 60 and 63, you can, there's typically been a $7,500 catch-up limit on your 401ks. For those between 60 and 63, that is now over $11,000
I love
of
that.
catch-up. Yeah.
And it's needed.
Yeah.
Man, it's needed.
Sorely.
All right. I think that was more than 2.
There's a lot of sentences.
Yeah, but hey, that's all right. That was good. All right, second question. I heard Trump promised to eliminate taxes on Social Security. Is that true?
Yes, it is true that he pledged to eliminate taxes on Social Security. Is that likely? I do not believe so, but time will tell.
Yeah, that would be interesting. I know 1 or 2 clients that would be excited about that.
Or 4 or 5 or 100.
Yeah,
Yeah.
yeah, one or two at least. But that would be that'd be quite the play.
Yeah. Yeah.
All right, finally, number 3, how can people plan for taxes if they inherit a retirement account this year?
If you inherit an IRA or a 401k or something of that sort, just understand that you have a 10-year amount of time to empty the account when you receive it. And you have minimum distributions that have to come out every single year during that 10-year period. So, again, talk to us if you're working with us, and we'll walk you through that. But we definitely want to be strategic with those inherited IRAs because they are fully taxable.
Yeah, that's a lot of. I mean, the good news is when we have all these tax law changes, it makes the advice that we give all the more important, which just means tap us. If you hear something, ask. Again, that's what this whole concept is here. If you've got questions that you want to have in the quick fire round, just email them to us, heyhobart@hobartwealth.com. Love to hear from you, Corey. I love those answers that you gave because they were, quick, clear, concise, but also, I got to tell you, impactful. And again, for some of you, rewind this. Listen to what Corey said. The catch-up for that age group of 60 to 63 is huge. Some of these benefits and the potential for the tax law being extended and what it allows you to do, huge. Or I guess it's 2025, so instead of saying huge, I say huge. I can't do a Trump impersonation, so no Trump impersonation. All right, Corey. Well, I appreciate that. And now we're getting a chance. Oh, I hit the wrong. So remember, if you've got a question, all you got to do with this is send it to heyhobart@hobartwealth.com, and you might be the lucky one to hear it live in the next month or so. All right, so let me go ahead and cue this up real quick. Our question is from Diane in Charlotte, North Carolina. And Diane said, "Hey, Hobart, I'm turning 50 this year and starting to get serious about retirement planning." Well, that's great to hear, Diane. She's asking, am I behind? What's my best move right now? All right. Well, that is a terrific question. And Diane, thank you for sending that in. Let me assure you, turning 50, it's a perfect time to begin to supercharge your retirement plan, and it's not too late. Here's the good news. At 50, you're eligible to do what we call catch-up contributions. That means you can contribute an extra $7,500 to your 401k and $1,000 more to your IRA in 2025. Just like Corey was talking about before, for those between 60 and 63, this is a ability to maximize what you got for those that are 50 and above. Max those out if you can. That's terrific. And if you've got Roth potential in there as well, be shoving money into that Roth IRA or Roth 401k. Also, I want you to take a step back and assess your full financial picture. What is your savings gap? What does your ideal retirement look like? Tools like the Hobart Wealth Retirement Blueprint, that can help you answer these questions. So just reach out to us. We're more than happy to help and give you guidance however we can. Also, remember that time is still on your side. Every dollar that you save now has about 15 years to grow before you reach age 65. So think about that beautiful word of compounding and growth. Now, to everyone else watching, Diane's story is a great reminder to not wait, to take this seriously. We've worked with clients now for over 20 years, and the one thing we hear from the most successful clients are they were happy they made the decision to be proactive in planning for the retirement, and then subsequently, it's given them comfort in retirement, and I've also allowed them to be proactive in their tax planning and retirement and all of that fun stuff that we get to do. So my encouragement to all of you, as well as you, Diane, start planning now and use every tool that's available to you. Now, if this advice was helpful to you, let me know. I love to hear when you hear something that says, that was great, or something that you heard from Jacob or Corey. Also, please like and share this webinar with your friends and your family so more people can just make smarter financial decisions. And of course, like I said before, send your questions to heyhobart@hobartwealth.com, and let's keep that conversation going. this wraps up our Wealthologist Live this month. So again, Jacob and Corey, I want to thank them for their fantastic insights. To our clients and folks that aren't clients that are watching, thank you for paying attention, sending in great questions. And next month, we're going to dive deeper into mid-year tax strategies. We're going to be a little bit further along in the current administration. We're going to see where things are settling out, and we're going to analyze some potential market shifts as we head into spring. So don't miss it, and submit your questions to heyhobart@hobartwealth.com, and we'll see you next time. Stay wealthy, everyone.